think there are some corrections which I want to make. You know, whether my introduction is needed or not. The point is that, am I on the other side or I am also on your side? So I still believe, and I continue to believe, that I am also, on the other side. Whenever you prepare something, present something, you learn a lot than, the others do. So I always believe that when a person is presenting something, I think he is learning more than what he is presenting. So hence, I believe that I am not a learned person, but I am a learning person. So with that, let me just start with, let me thank the chamber for giving me this opportunity to learn a lot. Whether this subject do I practice on a regular basis or not is not a material thing. What I look at it is that tax is something which I keep learning and I keep practicing, and this is just a part of tax, and hence I'll try and do some justice to this. Given that I work in an international firm, there are several scenarios which we have seen and several scenarios which we all would have seen working on that international environment. Given that, we are going to look at specifically two articles, Article 10 and 11, which deals with dividend and interest. Just before we start, why do we look at dividend and interest as an article and why we are so much interested in this? What is so relevant in the present environment? I mean, any thoughts from the, from the group? Why do we do that? Unless we know the objective why we are here, I don't think it makes sense us to proceed further. So, I would request all of you to please participate and help me in, taking this forward. So why do we want to know about interest, dividend, stuff like that? Especially in case of non-resident. I'll definitely give my perspective, but some thoughts. Paresh bhai, you can start with yours.
Certainly, non-resident are taxed on interest and dividend. Non-resident are taxed with a special provision for interest at least and not dividend, but dividend is exempt from taxes. And therefore, withholding obligation on 195 for dividend is of redundancy. Our interest makes sense because there are special provision for non-resident for interest, and if there are better provisions in the tax treaty, then certainly we would like to know whether there is a special article on interest and there are better provisions, then we can make use of that tax treaty. And I think that is the reason why we want to look at this special article.
Thank you, sir. Anybody else? So before I present my thoughts, let me just give a vote of thanks to Paresh bhai because he provided me all the material in relation to making this presentation. And I think credit goes to him. And thank you, Paresh bhai, for providing such a valuable material, very, very informative and detailed. Without that, it would have been difficult for me to even prepare to this extent. While what Paresh bhai has said from a tax consultant perspective is absolutely correct, but if I look at it from a businessman point of view, from a global economic point of view, now current requirement is funding not just from the local economy. You may have to go out, try and seek a funding from other country as well. Given that there is a cross-border funding happens, which are the ways of having funding from other countries, other economy, other jurisdiction. Now tax is just one cost in relation to the funding requirement. Now if I am planning a funding in another jurisdiction, do I need to know the cost of that funding, which includes tax as a cost of that funding? If I do not envisage this, I may not be able to take a considered call in relation to whether I should go for this funding or not. So from a businessman point of view, the way I look at it, that this article is more also relevant for me to decide whether which kind of funding I need to go for and what are the implications, especially given the cross-border and two different tax system or multiple tax different system levies taxes on it. It may so happen that such fund or income arising from that funding may suffer multiple taxes. How do I deal with it? Is there any way I can minimize my costs? Is there any way I can look at better instrument which is cost effective from the person who is funding and the kind of instrument which I should use? So with this note, I would like to take up this two articles. So one is dividend, another one is interest. And in fact, these thoughts which I gathered was from the first slide which was done by Paresh Bhai. And he had articulated so well in his presentation that why we have to study this. Though Paresh Bhai left it for me here, but certainly his thoughts were like that. So today in the agenda we are going to talk about dividend, how it is under the domestic tax law it is being dealt with, how under the treaty it has been dealt with. While discussing the treaty, we shall also try and see how other jurisdiction looks at it and what are the kind of challenges that arises and what are the different scenarios which are coming up. Similarly, we will follow the same method for interest. Then we will also look at some amendment to section 9 and how it impacts. And thereafter, the BEPS provisions which are being introduced, how it will be inducted in the system, whether it has already been inducted or not. Those are the aspects which we intend to cover. However, given that we are running short of time, I am not sure that how detailed we can get into each of the aspects, but certainly I will try and give justice to everything. So far as possible, we may have to skip BEPS. Probably we'll just flick through it, but we may not get into detail because BEPS per se itself is such a wide subject that it can't be completed in 10-15 minutes. So if need be, we can reassemble. Of course, chamber will organize something different for that, and I think one should do that. So dividend under the Act, I think we all would be aware what is taxability of dividend under the Act. Any thoughts, anything? Let's not make it monologue. I think we all practice, we know what dividend is and how it is being taxed. So any thoughts? Please share your thoughts. So dividend is exempt from tax for the recipient. Okay, does it suffer any tax? It suffers DDT. Whether all dividend is subject to DDT? Sorry?
Below 10 lakhs.
Below 10 lakhs. So what happens if dividend is received more than 10 lakhs? Sorry? I'm sorry.
The recipient also has to pay tax.
Recipient also has to pay tax
In excess of 10 lakhs.
In excess of 10 lakhs. Who is required to pay tax? Whether it is all assessee or it is individual, firm and HUF. Whether those are required to be resident or those non-resident individuals can also or are also required to pay. Only resident. So I think this is a fair summarization of the domestic tax law. Except one or few more things I would like to add. That there is a concept called fiction or dim dividend, which are being articulated in section 222 in form of subclauses A to E, where any distribution by company in form of to the shareholder in form of debentures, stock, debentures or any other deposit certificate, any distribution on liquidation, any distribution on reduction of capital any distribution or by company of accumulated profit, whether capitalized or not, if it is being distributed by way of assets of the company. Now the interesting aspect is that when any loans or advances which are being furthered to any shareholder or any concerns of the shareholder, that could also be termed as a dividend. Now all these dividends do not suffer any DDT. Given that it do not suffer any DDT, how it has to be dealt with in the treaty scenario? And that is going to be the more aspect which we might want to cover in this situation. There are various other situations which we may have to look at it. We'll come to that in a little while. So now, the most important aspect is that when any foreign company or any non-resident investor has two or multiple companies in India, it is very casual for them to extend loan from one entity to another entity rather than paying a dividend distribution tax and then advancing that money to the other company in India, which is a common practice. I think this provision was inserted much prior to that, when Indian companies started doing that. So what are the essential conditions to trigger this dim dividend concept? First, there has to be a payment by a company in which public is not substantially interested. And if this condition is not met, I think dim dividend cannot apply. So all these conditions given here are required to be met cumulatively. If any of the condition is not met, one can say that there is no dim dividend issue arises. There has to be an advance, loan, or any payment. Any payment makes it much wider than what is required. Payment should be made to the shareholder or a beneficial equity holder or a concern in which the person has not less than 10% of voting right. So the company who is advancing or paying, in that shareholder should have at least 10% of voting or beneficial ownership. The company making the payment should have accumulated profits. If there are no accumulated profits, still this provision do not trigger. Which are the situation in which company would extend the loan but does not have any accumulated profits? Say share capital of that company is acquired with huge premium and the cash is available with the company. Company has not performed or undertaken any operational activity, or currently there are some accumulated losses, but still it's a cash rich company. That company may be able to advance money to its another group entity, provided both are having a common shareholder. However, in this situation, there are, and we have envisaged such situation and we have seen that in such a case, dim dividend does not trigger. Payment should be made to a shareholder or a concern in which shareholder has a substantial interest. Now, what is substantial interest? Any thoughts around that? 20% or more. You are absolutely right. What we mean by 20%? Should it be holding, or one should have only voting rights, that is sufficient enough? It could be either or. Right? So let's take an example that company A has 100% subsidiary B, which has in turn invested in C, D, E in the ratio of 25, 100 and 15, and F, which is being held by A directly, Now what happens in this situation? When loan given by company C to B. So let me only articulate over here, makes it easy. When company C advances loan to company B, assuming that it has accumulated profits, whether this will be considered as dim dividend? Yes, given that B is a subsidiary, C is a subsidiary of B. If loan is advanced by C to D in such a situation, because they have a common shareholder, definitely it will consider to be a dim dividend. But what if C is to advance loan to company E? Less than 20%. Since there is no substantial interest, it will not be subject to dim dividend. What if C is advancing loan to F? Is F is the shareholder of C?
Yes. What are
F does not hold even indirectly. Can this be then construed as dim dividend? No. Absolutely right. Though A is a common shareholder, but I don't think it would qualify as a dim dividend. Now, it is so critical for us to understand this dim dividend because in a cross-border scenario, dim dividend could be subject to tax, could not be subject to tax, and hence it is very, very relevant for us to understand this concept under the domestic tax law. Because if it is taxable under the domestic tax law, then only we have to look at the treaty, but not otherwise. So it is very important, and I always believe that let's not jump to the treaty without looking at it from the domestic tax law perspective. Sorry, these are the answers which are being provided. Now we have already discussed that dividend paid when it is taxable, what are the tax implications. So I will not cover this slide right now. What happens if foreign dividend is received by an Indian shareholder? It is taxable in India? Will it be taxable under the treaty or it will be taxable under the domestic tax law? We'll see in a while. If there is a better rate available under the treaty, what should be your answer? Sorry? Now 115A deals with taxation of dividend at 20% without any deductions. However, if it has suffered so much of tax, then there is no reason for them to submit the tax return. Now in a dim dividend situation, if whether taxes are required to be withheld, not withheld, is a matter of debate. I don't think we have any conclusive answer to that. But certainly, one has to really look at it. If 20% tax is paid on a gross basis, then there may not be any requirement to file the return by the shareholder.
Mayur,
Yeah.
one question. A dim dividend, will it be considered as dividend under the tax treaty?
Yeah. So I am going to deal with it separately in the subsequent slide. And that is the point why I was just building up this domestic tax. So how likewise Indian company is getting taxed when they receive dividend from foreign company? As per the domestic tax law, if an Indian company holds more than 26%, then the tax rate which needs to be applied is 15%, which is much beneficial rate than anything else. Now let's jump directly to the treaty. Article 1 deals with allocation of right. Now there has been, while OECD and UN model were getting finalized, there was lots of debate and dispute occurred. Who should get the right? Should a country of residence get right to tax that income? Treaty by default generally gives right of taxation only to the country of residence and not to the source country. Hence, this has been a challenge. Therefore, the language, the way it has been worded, dividend paid by a company which is a resident of a contracting state to a resident of another contracting state may be taxed in the other state. The word maybe is being added, giving no conclusive answer who has a right to tax it. However, for the sake of easy reading, I have just articulated this article in a different manner. Dividend paid by a company which is a resident of India to a resident of Singapore may be taxed in Singapore. So the rule which is applied over here for allocation of tax is distributing. First right to tax this income is with the residence country, and subsequently source country can also tax it. Here very interesting point is that dividend paid by a company. What if dividend is declared but not paid? What happens to such a situation? And this word paid can really help us in deciding in the case of dim dividend situation. And hence, I am just trying to make or trying to emphasize on the word paid. So how do we construe the word paid? So word paid it requires very wide meaning. And what is that wide meaning? Wide meaning would mean that if fund is available at the disposal of the other person, or it is unconditionally revoked or transferred to the other person, to the shareholder, then dividend can say to have been paid. Now Supreme Court in the case of J. Dalmia has said when company discharges its liability and makes a dividend unconditionally available to shareholder, then it can be said to have been paid to the shareholder. Now which are the situations it tries to cover? We really need to go back to the Companies Act. Once the dividend is declared, within how many days it has to be paid to the shareholder? And if it is not been collected by the shareholder, does it have to be deposited into an escrow account? Will that mean? Then that's where I am coming from, the concept of wide definition of paid. Can we say that fund is unconditionally available to the shareholder, given that it has been kept in an escrow account and therefore it has been paid to the shareholder? And this is what Supreme Court has held in this case. Now what should be regarded as a company is a matter of debate, and one has to really look at, dive deeper into it and identify whether certain form of entity would be regarded as a company or not, such as US LLP, LLCs, Indian LLP, or any other such form of entities. There is no one answer to this. I myself have examined several LLPs and LLC. And in one case, we have come to a conclusion. One entity is a company from the Indian tax point of view, but in the same manner and breadth, the other LLP is not regarded as a company. because of the typical features which are being there in that entity, which will decide whether that can be regarded as a corporation or not. And hence, before we take a call whether it constitutes a dividend or not, this aspect needs to be examined very, very carefully. Now, our paragraph 2 deals with whether source country has a right to tax. If it has, then to what extent or at what rate they can tax it. Now, very interestingly, and I am not going to dive deeper into it right now, but the principle is that yes, source country do have a right to tax it in India. If dividend has already suffered DDT, then this entire treaty or article fails, and therefore it is irrelevant from our perspective. So far as today's discussion, it may be more academic rather than we are going to use it. However, it is also very, very important to note whether treaty would apply or not apply, or which treaty should apply. And the wording in relation to that, somewhere it says the person who is receiving the dividend should be the beneficial owner. If he himself is not a beneficial owner, then in such a case, this article, one has to really relook at it. Or the treaty which we are looking at it, we have to relook at the treaty. Which treaty should apply? Let us try and explore one example. That if US company has made investment through Mauritius, and a Mauritius company has made investment in India under a staple stock plan. In such a case, whether who is the beneficial owner of shares of an Indian company in a staple stock scenario? So should we apply India-Mauritius treaty or should we apply India-US treaty for that, assuming that DDT is not there and it is subject to tax? Sorry, I am not getting any answer. India-US treaty. Answer is absolutely correct. Because treaty would apply only and only if the person is a beneficial shareholder. The features of staple stock is that whatever is being gain or dividend arising on a stock, it will have to be immediately passed on to the main shareholder or to the US company. If any voting needs to be casted, it has to be casted only upon a preference provided by based on the preference provided by the US company. Given these kind of features being there, it should be considered that US company is the real owner of the asset. So how do we determine beneficial ownership? Any thoughts? Of course, I have put a definition which has been provided under the Act. But how do we determine beneficial ownership for the purpose of treaty? And this, we are going to spend little more time on this because this is common for dividend and interest. So I would request you to please, participate in this discussion. It will be really helpful. So any answer? I mean, one can really read and answer it. It's fair. I just don't want monologue. That's the reason why I'm asking questions. Yeah, any thoughts?
Who's the ultimate owner?
Who is the ultimate owner? How do you decide who is the ultimate owner?
Was paid.
Sorry?
What paid the consideration?
Who has paid the consideration? See, if I create a conduit in say any other tax haven, then the money is coming from that entity. So can we say that is the legal owner? From a legal perspective, that is the owner. Nobody can deny that Mauritius company or any other tax haven country where the entity has invested in India will be a legal owner. But we are talking about beneficial ownership and not legal ownership. So I just wanted to, and thanks for bringing out this point, that beneficial ownership is different from legal ownership. So that's one concept which we need to remember and we need to understand. What are the other features which we can understand from here? I think we can look at McDowell's, how it has been considered as flow-through. Those principles needs to be applied over here. Yeah? Anybody? I think as I said, I am going to learn from you guys. Please teach me. So, the funding has happened directly or indirectly by a person. That funding is conditional or being controlled by the person who is providing the funding. Appreciation or results are being enjoyed or it is at the disposal of the real owner. In such a case, that person will be regarded as a beneficial owner, and that is how it has been read under the explanation 4 of section 139. That would mean that assets or income, whether in form of capital gain or in form of dividend or any other form, is being controlled by the beneficial owner. In such a case, the beneficial owner would be the person who has provided the funding. Any examples how one can structure such a transaction? I mean, theoretically it is good, but practically how in reality it works? If somebody can give some examples to that effect. Otherwise, this becomes academic discussion.
By creating the overseas trust and the money coming through the underlying company, so the beneficial owner is different and the money has come to the...
Yeah, but live example which we have seen or which we can relate to.
Vodafone.
Vodafone, well, I may have a different viewpoint on that because that's highly debatable, but certainly one can really look at it. Any other example? See, which clearly evident that yes, it is the beneficial owner is different. I mean, if I look at P notes, very clear example. Direct correlation. Who is the beneficial owner? So, such instrument, probably we might want to go little deeper into it and try and understand that how it really works. And therefore, it is very, very important for us while whatever we are learning, try and relate it to the real life example so that, we can understand this concept much, much better. And I always prefer to do it that way. Similarly, under the treaty, as beneficial ownership is defined. Is beneficial ownership defined under the treaty? I don't think any of the model beneficial ownership is defined, and therefore there are number of books containing 200-300 pages which defines beneficial ownership. Now at the same time, if we look at Article 3, which provides definitions for the purpose of treaty, takes us back to the domestic tax law. If any terms which are not defined, one needs to fall back on domestic tax law. Now the situation is that one explanation has been added very recently. Does it mean that the treaty where beneficial ownership is not defined now, which was signed much prior to this definition, we need to follow the definition provided under the domestic tax law or differently? Any thoughts around it? How do we read treaty vis-a-vis act? Can treaty be treated as a law? Sorry, any thoughts? No?
Yes, sir. Treated as law.
Yeah. Is it or is it not?
It is.
It is. In a way, yes, but my answer is a little different from that. It's a contract between two parties. The contract, when a person agrees, they have a basic understanding what terms and conditions for them it would mean. And therefore, if a particular item has a definition which is common for both, then the contract can be honored in the same manner. And I think it will take us back to Vienna Convention. Whenever we are interpreting a treaty, both the country needs to have a similar or same interpretation. Otherwise, it can create a chaos. Just to give you an example, that if beneficial ownership is very restrictively defined under the Indian Income Tax Act, and it is very widely defined under the domestic tax law of other country, what will happen on the same structure? If India is investing, they would have a problem from beneficial ownership point of view. At the same time, if from that country any investment is coming in India, it may be treated completely in a different manner under the same article. And therefore, it is a contract. And therefore, the interpretation of each term needs to be considered in the manner in which other country would take it. And that is the very reason why, if you see, MAP has been inserted in each of the treaties. That is to resolve such disparity under the treaties. So these are the basic interpretations of treaties, which I think we will take it up later. But these are the aspects which one needs to consider while evaluating this. So, the discussion which we had of beneficial ownership, OECD model or UN model confines to those kind of definitions only. So Indian definition is not way different or different in any manner from the treaty, and therefore do we really need to worry? Answer to that is no. So the way we have discussed that beneficial ownership is not a technical word which we have to understand. It has to have a wider connotation, and it has to be used in the context, or it has to be interpreted in the context in which it has been used. So one has to look at substance over the form, and just don't follow the substance, don't follow the form in which investment has been made. And that's the very reason why we concluded we should look through legal ownership and we should look at the beneficial ownership. I think similar principles were also identified by AR in NatWest, where beneficial ownership is considered where a person who is able to control capital or assets of the company, or any yield from that asset is being controlled, or both of them are controlled in any of these situations. Person who is controlling will be regarded as a beneficial owner. I think these principles has been reaffirmed by various judicial precedent. Very interestingly, even JP Morgan Chase Bank has also faced a similar challenge in UK. Now, are there any other? So, how do we appreciate the circular of CBDT, which talks about that once you have obtained TRC, that is a conclusive evidence that a company or an entity or a taxpayer is resident of that country? Can one overlook that? What are the thoughts of the group? How many are agreeing to yes? No? Okay. And how many agrees to no? So very few. So why yes and why no?
TRC is because Azadi Bachao Andolan has told us that you cannot go beyond TRC, and TRC is a conclusive proof that person is a resident of that country.
So if
For
any,
X purposes.
correct. So if anything which is being added in the treaty saying that you have to look at the beneficial ownership, still in such a case would you believe TRC is conclusive evidence?
Yes.
Okay. And the person who said no. Yeah.
But as you said, the dividend has to be seen from the ultimate beneficial owner. So only you cannot stop at a particular level and see, okay, yes, there is a TRC, so I will stick to that particular company or a particular country.
You are absolutely right. So the answer is no. If you really look at it, and I think Vodafone reaffirms that position, is that one has to really look through, specifically when under the treaty it has been provided, even if you are a resident, but the benefit is available only to the beneficial owner. In such a case, we can't take TRC as a conclusive evidence. We need to go beyond that. And I think that is how one really needs to look at it, and just don't stop that once the TRC is there, we may land up in a greater difficulty in case of beneficial ownership in that situation. So here, otherwise treaty shopping can become very easy from an India standpoint, and therefore I think one really needs to look at it from that point of view.